Welcome to Private Equity Outlook 2025, our panel discussion here. As Marty said, I'm Jacqueline Grace. I'm the CEO of the Global Transformation Initiative and the GTI Foundation, a coaching, consulting, and communications firm that teaches healthier relationship skills and relational science in workplaces, schools, and homes, prioritizing three core values: decency, human dignity, and relational leadership across ages and sectors. GTI works with organizations and individuals who care about how they show up in the world and who want to make a lasting impact on their businesses, families, and society at large. So today, we expect a robust discussion here around the outlook of private equity, and I'm tremendously honored to guide the discussion with these five fantastic, amazing panelists, truly. It's been a pleasure just to get to know you briefly over the last couple of days. And Jason Frank, Marco Soriano, Gary Post, Samy Dwek, and Rob Blabey. I'm going to ask each of you to do a brief introduction as you answer a question. You each have your own unique perspective and approach regarding private equity. And so I'll jump right in. Just a reminder, brief intro as to who you are, how you approach your work. And the question is, where do you see the most activity and opportunities right now? And how do these opportunities fit into your strategies? So I guess we'll start and go right across.
Good afternoon. Hopefully everybody isn't in too much of a food coma. This is like the perfect slot, right? Like right after lunch, everybody's sleepy. Let's talk about private equity. Good afternoon, everybody. Jason Frank. I am not a private equity person. I'm not a family office person. So let's get that straight. I'm an investment banker. So you can start, just don't throw stuff at me up here, okay? I'm president of BDO Capital, which is the investment banking practice of BDO. BDO is the fifth biggest accounting and consulting firm in the world. We're typical buy-side, sell-side representations, debt and equity capital raising on the institutional side, strategic advisory projects, as well as ESOP conversions. We work primarily with small to mid-market firms, that being founder or family-owned businesses, usually first institutional capital in. Enterprise value range is usually $50 to $500 million. We've done much bigger. Thank you. We've done much bigger. We've done much smaller and everything in between. We are industry agnostic. What I like to tell people is that we've pick an industry sector. I'll tell you 5 deals we've worked on, and then I'll tell you another 5 that you haven't heard of that we've worked on that are bigger than the 5 that you did. What was the question that I'm supposed to answer?
The question you're supposed to answer is, what's your name?
I got that one straight.
Did that one well. And where do you see the most activity and opportunities right now, and how does that fit into your strategies?
So as an investment banker, I do a lot of, for 30 years, I've been doing creating relationships with some of the biggest asset managers of the world, as well as some of the smaller ones and everyone in between. I personally think the private equity market these days needs a massive correction, just like everything else does in our economy, meaning there's way too many private equity firms that are out there that have way too much money that needs to find a home. There's $1 trillion of dry powder right now that needs to find a home. I think most of that is on its 4th year, meaning it needs to be put to work and put to work fast before it has to be returned. The private equity market is too competitive, too many players. It needs correction. And I know we're going to talk about liquidity and all the issues that are happening right now. There are some significant sectors that are very hot with very high multiples: healthcare, technology. Really, there's good companies in every industry sector that are going to trade for high multiples. There's not one sector better than the other. They're always good A quality assets are going to trade at high multiples because there's such a huge demand and such a small supply of them. So there's so much money. Everyone, if it's worth 10 times, it's going to get bid up to 15. Someone earlier today mentioned the RIA space, how they're going for 20 to 25 times. I can vouch for that. I just sold one for 22 times. It's insane. If someone sees something that they like, they're going to go after it and spend a lot of money doing it.
Thank you, Jason. Marco.
Damn, that was long. Marco Soriano, 4th-gen family office. Global transformational is a big part of our strategy these days. We're in 4 different sectors: telecommunications, real estate, obviously as a backed asset, automotive, and technology. How we source these deals, and I think that's part of going forward, is how impactful these companies, these investments truly are to our current society, the way it is. I'm not money driven. I'm not numbers driven. I'm driven by the fact that people are who run these companies. And if we truly are here to make a transformational, globally impact, that we should look at things in certain ways. I vouch for legacy as a 4th-gen, trying to pass this on with my children. So my way of looking at things today is the geopolitical situation in the world is the way it is to make sure that whatever we do does add value to our culture or to society or communities or country.
Thank you, Marco. Rob.
Yeah, good afternoon. So Rob Blabey, family office. We invest in all directs, and we do it in an opportunistic and absolute return manner, which means we look at things in the public space, private space, debt, equity. We don't do a lot of transactions, maybe 3 or 4 a year. So we're fairly concentrated and deep dive. And we focus on things that are mid-duration, or we term them as mid-duration, so 1 to 5 years of expected hold time. And where we're seeing opportunity right now is, and we do a lot of family-to-family investing, but where we're seeing specific opportunity, we've done a few transactions in the last 9 months or so, is in sort of what I'll call growth equity, so minority holdings, but things that have actually struggled to raise capital. So they were often raised money at higher valuations maybe 2-3 years ago. The businesses tend to be working and performing pretty well, but they need more capital to achieve their ultimate goals. And so many of them have stepped in and have had bridge rounds and things like this from prior investors, and we've been able to find some interesting opportunities there. And I expect to see more stuff in that space where we can get in at attractive levels and see a path to them getting cash flow positive.
Thank you, Rob. Samy?
Good afternoon, everyone. Samy Dwek. So I'm a family fixer. I work with single family offices and family principals, but in the context of this panel, I sit on the investment committee and oversee for a single family office close to $2 billion. I would say about 40% of that is in real estate. So when we look at private equity, it's everything ex real estate. I think like Marco, we look to be impactful. So we look at sizable tickets. So we don't do anything under $5 million. We look less at directs because it's just too much brain damage. So we are looking more at funds. We do a lot of analysis. We have a 20-person team. I would say in terms of what is hot on our plate, I would say defense is one because we're seeing a lot of spending and that links to high tech. And then the other place that we've been looking at is everything around AI and in particular AI infrastructure. We see that as something that will continue for the next generation at the very least, regardless of how you see AI develop, the infrastructure necessary to support it has to grow, and that's going to come from the private sector.
Thank you, Samy. Gary, over to you.
Hey, thanks very much. Can I be heard well out there?
Hear you well.
Wonderful. I'm Gary Post, live in Los Angeles. I'm a family office investor, but what started with my family 11 years ago has ballooned to about 30 families that we invest for. We're growth capital investors, meaning we're looking at companies 5 to 10 million in revenue up through and including SpaceX. Our entry level type investment is with a company that has sales, has product, has technology, and needs additional resources like a large scale sales force to grow. So we continue to see opportunities building on our theme of let's use information to do things better. So we're automatically creating a social good because it's better for families, better for everybody in the companies that we work with. We're seeing a great opportunity ahead, not in the very large language model companies. Frankly, I don't understand those, but we're interested in two spin-offs of that, which one is picks and shovels, which, for example, we invested over a year ago in CoreWeave because it was providing something that was extremely necessary to the AI industry. So we invested in CoreWeave because it was a proxy for the AI industry. And at the same time, we're looking at vertical AI applications. It's just a one step logical extension of what we're already been doing. The puck, I think, is coming to where we already are, which is companies using information to do things better.
Great. Thank you, Gary. Thank you. Jumping over to the next question that has been posed, and I'll share with you all. If family offices are rejecting fund structures, what other types of structures are they using? And for fund managers, are you receiving requests to adjust your structures accordingly? And maybe we'll start with you, Rob.
Sure. So, yeah, so we do in direct investing, not fund investing, but we've seen, I think, on the back of the higher interest rates we've all experienced in the last few years, you're seeing a slowdown in fund liquidity and rotation of capital, and so that's led to, I think, fear, quite frankly, in certain categories of the investing community around, lockup and drawdown vehicles that can have very extended terms, as people are learning now, and slow rotation of capital. And so, so we are aware of folks that are more inclined to look at SPVs, co-invests, one-off things where they can be more in control of their destiny and their capital outlays, and where they're finding more choice and flexibility on sizing and things like that. So that's definitely a theme, I would say, and they can take all sorts of, whether it's SPVs or we heard talk earlier today about secondaries. That's another way to sort of play in a shorter duration capacity, and then obviously as co-invests and that kind of thing.
Okay, thank you. Do you want to jump in, Marco?
Well, in a similar fashion, we look at private equity deals as a co-investment, not us giving them money to manage and drop into whatever they think is good for us, because that's not necessarily the case. It's what's good for them.
Mm-hmm.
So in co-investments, we look strategically at anything that can be vertically integrated into our existing platforms. For example, with telecom, when you have access to millions of clients or users, there's so many different things that you can promote to that public. So we consider ourselves a distribution channel strategically for businesses that need to grow to that stage, and that has value.
Mm-hmm.
So it gives me the negotiating card to be able to position myself at a much lower valuation, or maybe a better co-investment position. So again, depends on what they're looking at. We'll cherry pick and help them grow. So otherwise, we just don't see it.
Thanks, Marco. Jason, you want to contribute?
So from the investment banking perspective, and seeing a lot of different funds and the troubles that they're experiencing right now, kind of to follow on what was already said, a lot of managers are just looking for flexibility and control, which they don't have right now. And it's kind of a new experience for them because of the liquidity crunch that they are under. They don't really know how to react. I don't blame them because it's a tough spot. They have a little bit of money. They're not willing to sell their portfolio companies because they were bid at extremely high multiples, and those multiples they're not going to get right now, and potentially have to refi and fix their cap structure before they go to market. It's a troubling situation, let alone the new fundraising environment is extremely long. It's extremely brutal. Doesn't matter how successful you are as a fund. Some of the biggest asset managers in New York right now in the world, the KKRs, the Apollos, the TPGs, on the equity side, they've been trying to find, KKR had 7 different equity strategies in the market at the same time, trying to raise funds. It took them 2 years to raise them. That's KKR. Apollo, they had their last equity fund was 20 billion. They tried to raise 25 billion. They couldn't. They closed it out at 20 billion and didn't even announce it because of they couldn't do it. They were embarrassed. It was a red flag. I mean, it's a
25 billion. Come on.
that's 20. But the interesting is that's 20 investments for them.
Yeah.
Right? They do $1 billion investment. So the liquidity crunch is really a difficult issue, and they're trying to construct and kind of looking at their current structures, and for the new funds that they're doing, trying to set up those structures to provide them with as much flexibility as possible.
Thank you. Gary, you look like you want to jump in and make a comment.
Yes, that's quite correct. We observed this kind of trend, and we are on our committed capital third fund, backed entirely by families. And what we've launching now is a managed account program. It's for families or wealth advisors. And what people want from us, we think, is access. They want to know where good deals are, and you can't get into them if you're sitting in Luxembourg and you're not going to that Little League baseball game in Palo Alto to pal around with fund managers and other investors. So what the managed account entails is we provide access, but we work with you to develop a strategy, early, late, some combination, health tech, information services, things you're interested in. And then after that strategy and after the access, the amount of investment for each individual is your choice. And whether you like or don't like an investment, it's your choice as well. So we think this is the future of family office investing, to provide something that directly reflects the needs and wishes of the investing families, or in some cases, a wealth manager acting on behalf of families. We are not institutionally driven, not even 1%.
Thank you, Gary. Thank you. Samy.
I mean, the only thing I would say, because I feel like I'm sitting in a different seat because I represent one single family. So we stay away from the really big funds because I think that they're going for big plays and it's harder to give good returns. That's why you see the secondaries market become so interesting for people, because they get into those big things, they don't start to give returns, and they look to exit. So we're seeing a lot of change in private equity world, these evergreen, more liquid versions. Not a big fan. I think you give up return. SPVs where they make sense. And I find that some of the funds, when they're looking for follow-ons and someone to co-invest, that's interesting. Those are SPVs on the side of a fund. So I think in terms of the development, you've had the regular big old funds, the niche players within it, you've got the SPVs, and now you've got the evergreens. So there's a lot of choice for people. What I really hated is when you saw the Apollos and others starting to sell the management company as a stock, and people think, oh, I'm getting access to private equity, but you're not. You're getting access to the management firm, and it's not going to give you the same returns. And in fact, I think they found out very quickly it did not return at all. So it's a very interesting place to play, but you need to be careful. You need to do your due diligence. You need to have people around you and know what your options are.
Thank you. Samy, you mentioned liquidity. So can we stay with you for a second and ask to just go a little bit deeper? There are many questions about liquidity right now in private equity. And at this time, it seems that people are, in fact, looking for liquidity. But how should family offices approach providing liquidity or selling stakes and set in the secondaries market? And what are the best strategies today in terms of liquidity that you're seeing?
So from our standpoint, if we're going into private equity, we're looking at it as a buy and hold. You're not looking at it as I need to exit or I need to get liquidity. If you're doing that, you're in the wrong space. Go to something more liquid, go to an evergreen where you can exit after maybe 2 or 3 years, and there's a penalty to get out early. We look at other parts of our portfolio if we need liquidity, the more liquid parts. Secondaries has definitely been something that has enabled people to exit. Keep in mind, you're getting penalized to exit. It's not that you're exiting at market value, it's sub-market value. And the discount is really dependent on not only the performance of the fund, but how many secondaries are looking for deals, right? And there's a lot more people now in the secondary space trying to play there. I think that there was one of them recently who just decided not enough juice out there, and they closed their fund before they called a single dollar of capital. Again, I think you've got to look at your liquidity needs as a family, determine what your needs are, and then from that approach private equity carefully, that you're not a forced seller to a secondaries fund.
Thank you. You want to jump in, Marco?
So from a family corporation point of view, all of our operating companies, you can set up in a structure where your financial advisor of a given bank can open working capital managed accounts. Not every company needs to be sitting on hundreds of millions or millions, for that matter, in a single bank account that is not earning any interest, but you can make that money work in the market. And for liquidity purposes, you look at money market accounts, something that is completely liquid, and you just call the capital as needed. But you have to train these companies to call on that capital when it's needed. And so we manage all of that under a single dashboard. Give you an example with Merrill or Goldman, where I can see all of my companies, all of the working capital that is being managed in the market, and how capital is being called on, say, trimesterly. And then you have a better control on the burn rate and how these managers that you have in all these operating companies typically manage money themselves. And they're just not going out there and spending money like it's free. And that tends to happen often as well. So those are structures that I always suggest anyone who has got different managing companies, especially a family office, and you can see all that under one single dashboard. So that's our strategy, and it's been working for us for the last decade.
Great, thank you. Gary, you want to hop in?
Yeah, I think liquidity, it's maybe a little late to discuss it, but liquidity is partially planned before you make the investment. And what are your needs? You have to expect along a time frame if you're a seed or Series A investor or a buyout firm, because it's just the nature of the beast. But what we're looking for is companies that already have a stated claim that they will go public or want to go public, or that they're going to be traded on a secondary market, and that's become very, very much more liquid. So we ask companies, what are their plans? And we get some very specific ideas, or we don't have any plans to ever sell, or we want to do 2 acquisitions on our platform and then we're going to sell. So part of it is planning up front for future liquidity by the kind of companies you invest in.
Thank you, good point. Jason?
So from the M&A transaction perspective, you have private equity funds that have a set duration that they have to deploy their money, return their money to their LPs. That timeline has been extremely stretched out. They're in a liquidity crunch. They're having issues. As the investment banker working with founder and family-owned businesses that are looking to sell their business to the right partner. It's not all about dollars anymore. It's about selling it to the right partner. Family offices have a significant advantage today over private equity. That's because most family offices, in a macro perspective, aren't forced to sell that investment after 5 years, the life of the fund. A family office can hold that investment for an endless duration. And to the business owners that we're representing, that is a massive attraction to a family office versus private equity. So the liquidity crunch that private equity funds they're at a disadvantage to begin with, but it's creating like almost systemic issues that are hurting their business and definitely leaning more towards family office.
Rob?
Yeah, just to add, I think if anybody in the room or listening in is considering building a private equity portfolio today and thinking about liquidity in the future, it's important to space it out and so look at different vintages. So not deploy it all in 1 year, but to stagger it. It's also important to slice it from an investment perspective, i.e., ventures typically going to be longer than, later stage growth or LBO potentially, and certainly direct lending is a category that, is paying you back in regular intervals while you've invested. So you're sort of earning you back your liquidity in real time. So there's ways to build a comprehensive portfolio where you're getting, effectively elements of liquidity during the staged period. But I don't think anybody should enter the private equity category, broadly speaking, or venture category, and think that it's anything less than a decade.
So some concerns have come up, and so we're wondering, what else are you concerned about? What are you avoiding? How are you managing risk? And maybe we'll start with you, Samy.
Yeah, lucky me. What are we avoiding? So at the moment, private lending seems to be overdone. We've started to step away from that. We see cracks in the armor. Like I mentioned at the beginning, the opportunity set for us has been defense, infrastructure. Infrastructure has always been something out there that's interesting. We're not looking for knocking it out the park, 20% IRRs. We're looking for something more modest. We're not big risk takers. And again, private equity, coming back to the point just made a second ago, I think by Robert, was, we build out that portfolio over a period of years where it starts to become self-funding. You look in each vintage, what are the opportunity sets from that standpoint, looking forwards, not looking backwards, not what did well in the past, but what the opportunities are. Defense, with all the noise you're hearing around NATO and everything else, becomes very, very interesting. Anything that is more oil cyclical, with Trump pushing the pump, and let's get oil down, you want to stay away from those. So it's being very, very cautious about what is being said and looking for opportunities of the moment, that if you build your private equity portfolio correctly, it should become self-funding. So if you choose a 20% allocation to PE over a period of 6-7 years, if you build it correctly, you do a right asset allocation in terms of not just the vintages, but also the different strategies. We've not been looking at buyouts at all. We've stayed away from that. M&A has not been where it should be. We were hoping for a change with the new administration. We thought that would be more business friendly. We haven't seen a pickup in M&A. Biotech has been horrible. We've avoided that. Biotech was all based on buyouts, and that's definitely not happening. So that would be kind of my key points.
15? Okay. Jason, I think you mentioned something about AI. Am I remembering that correctly, or someone did?
Sure.
Being concerned.
Everybody talks about AI. Every conference, every meeting, it's all AI. That's where all the money's going. And the scary thing is people really have no idea what AI is, what it's going to become, what it can do. They just like the 2 letters, and you could literally attach it to, like, oh, look, it's an AI microphone. Give me $1 billion. People have very short memories, right? Just a few short years ago, there was this thing called the internet. Everyone was investing the same exact way. Of course, there were some winners. There were so many losers. It's the same thing's going to happen with AI. Billions of dollars are going to get thrown down the drain just simply because it was attached to AI. It's going to be a game changer for our society. There's no doubt about it, but no one has any idea what it is, which is why everyone's throwing money at it. But it has significant challenges from a financial perspective going forward, just because who knows what it's going to turn into. But people are just throwing money at it like they can't do it enough. And there's going to be a lot of losers.
Marco, concerns managing risk, AI or otherwise?
Well, AI-driven systems, if you recall, Hanson Robotics, Sophia the robot, 15 years ago, we were among the first investors in machine learning, which is what it was called. And those systems that are became trading system platforms, and people are talking about AI-driven systems in our case with electric vehicles, which we're in the manufacturing and designing business of this, is how do we use data of the vehicles that you're driving or riding in order to promote reports to the banks? Because the banks talk about these companies, when you're driving your Tesla around, all of that data that is being collected is being sold behind you to the bank so that they can report on these machines, engines, quarters, transmission gears systems. AI-driven systems will collect all that data. But the biggest problem here is, where are these data centers? So today's talk, and something that we're looking at just ahead of the curve, is space or satellite space centers. And this is a conversation that just got started, but basically using solar power to power the satellites that collect data, hence taking away the problems that we have with energy, taking away the problem that we have with our ecosystem, because we're damaging our planet and we continue to do this. And again, this whole ESG sustainable approach that people talk about, but they have no clue that by investing in such systems, we're contaminating our planet. So I go back to what I said earlier. We look at how companies are behaving and the impact that they have in our planet, because that's the true legacy, if you want to talk about that, that we should be thinking about.
Thank you. Gary, you want to hop in?
Yeah, just quickly, our thought is companies that we look at must do something that absolutely improves profitability and the usability for consumers or companies. We think diversification and more positions is helpful. We're probably double the amount of positions that people look at in growth capital funds, and we're a bit earlier stage than some of those across the board. Companies that can fundamentally do things better are very desirable. We look away from, again, I said, the large language models. We can't figure them out. We think there's a lot of hype in AI, but we also think there's a lot of promise. So it's the major risk is also the major opportunity.
Thank you for that. Rob, you had mentioned that you have a unique approach, particularly to assessing risks. Did you want to chat a little bit about that?
Yeah, we kind of joke around the office that there's a 100-year storm every 2 years now. So one of the things we do with that as a kind of overreaching theme is that we look at everything at an intrinsic value level, sort of almost like a credit. And so we evaluate even all equity investments as what's it really worth in a pretty dire kind of liquidation scenario. And so I've done a reasonable amount of distressed investing in my career and have seen things at very distressed levels. And so it's, for us, we really, we stress test things to that extent, and have plenty of examples where our stress tests have not been even strong enough. So so we've lived it. But big picture, we feel that duration is one of the key attributes to managing risk. So we don't really tend to look at anything that would have us be an investor or owner of for over 5 years. And so if you're, looking 5 years and down and sooner, then, you're kind of in a portfolio scenario, you're at about a 3-year average hold time, which for us is, we believe, optimal. And that means that, if once you're kind of in your cycle, you're getting all your capital back, or you're getting returns at about a third of your capital every year. And so from a risk standpoint, that allows us to sort of play the macro events as well. So if we're constantly recycling about a third of our capital every year, then when macro events come in, good or bad, we're able to, kind of manage our internal capital and recycle at hopefully opportune times when macro events allow for it.
Makes sense. Marco, you and Samy have both mentioned opportunities going forward, and I wondered if you can talk, and others as well, talk a little bit about the best opportunities that you see in front of us right now. And I know you've talked a lot about setting new standards of excellence, which I find fascinating. So maybe talk a little bit about that.
Well, it's more from a human capital point of view that I see standards of excellence as a leader in what people talk about in leadership in these companies. What are the traits you're specifically looking in the management behind the companies that you're investing in? Are you really taking the time to get to know the people behind the engine, behind the companies? And in most cases, where I see with funds, not the people, not the actual relationships that you have to build over time, because that's extremely important. So we take that excellence, the standard of excellence, to understand people, emotional intelligence, awareness. What I see today is probably what you are seeing is a disparity in humanity. There is people that are trying to be good, better themselves, and there's people that don't care anymore. There's no remorse. The fact that we're still fighting wars at the level that we are, and we're still thinking just to make money, there's a disparity. And I'm trying to, as a leader in my family corporation, family office, teach our children to be a lot more aware that what we do, and this is something that your parents told you, has an impact on somebody else. And we should make decisions based on that. So this is the standard of excellence that I thrive for today.
Can I
Thank
just
you.
add?
Sam-
Can I,
Please. Yes, Sammy.
sorry, forgive me. It's hard being online. I just want to add something to what was just said because I think it's very important.
Of course.
You mentioned ESG, and let's put ESG to one side because ESG, what it was meant to be and what it's become, is not aligned, right? Because when you see oil companies in an ESG index and others, you go, that's not ESG. Like, guys, you've lost the plot. But that doesn't mean we can't be doing good. And there are impact investing. And I think we need to be careful. Impact investing, you're not looking to make profit. That's not the game. The game is to help those in need and enable them to, it was what we used to call microfinance, right? Became impact investing. It's the real true ESG in the way it's meant to be. Okay. And that's something we shouldn't forget that lies within private equity world, but it's not a game to make money. It's a game to enhance and improve society. So don't forget that as part of either your philanthropy or part of your investing, but don't expect big returns. In fact, if you break even is good, and if you make money is like wow, because that means you can reinvest into the next sphere. But there you need a network of family offices sharing KYC because you've got to do your KYC. It's very expensive for the amount of money you're investing. So I just wanted to add that.
I just want to remind everybody that the Women's World Development Bank is headquartered in New York City. It's a $500 million endowment. And they deploy $500 million in micro lending to women all around the world.
My wife, that.
Yeah. Rob, you want to jump in? Thanks, Gary. Thanks, Sammy.
Yeah, we're seeing opportunity and have done some things recently in the capital space in reshoring and in basically security detection, I'll call it. I think it's the best way to clarify it. And then in food retail. So those are areas where we see opportunity right now. I think in the short term also that the digital assets category with the recent regulatory improvements, I'll call it, from the SEC and whatnot is opening the door, I think, to more advancements in blockchain digital assets category. So we have some exposure there as well that we expect to do well, and that's probably a shorter term turn in our estimation.
Great. Gary, you want to hop in there? I see you have a look on your face like you want to say something.
I think we're looking at companies that make life better and improve how we live. and improve efficiency. And so our impact is changing the way things are done to make it easier, more profitable, more convenient. And we don't have a measuring stick out, except that every company we invest in should be doing this.
We're good. Jason's going to go, and then we're going to wrap up.
He's giving me crap, everybody. So I agree with everything. I don't have much to add because I agree with everything that everyone said. I do think, however, that the current marketplace, specific to United States, specific to the administration, because of Liberation Day, because of the big beautiful bill, whatever's coming out of the Senate in version 2, et cetera, there's a lot of the marketplace, business owners, investors are frozen. No matter what the opportunity is, people are stuck. Not because they don't see the opportunities, they just don't know what lane the administration is going to choose. And whatever they choose today, it changes tomorrow and then changes the next day. So until the administration actually is very clear in the pathways that they make decisions on with the budget, with immigration, with investing, regulation, et cetera, people that have the right ideas, that have the right investment theses are just stuck. And I hope that changes.
Great. Thank you. Closing remarks, really 20 seconds each. Anything you want to share to leave people with as they depart today?
The quick thing, whether you're invested in companies or you are the company, you need to have the answer to the why now. People should invest. Why should you invest in those companies? If you cannot answer that question to yourself, for yourself, you're not doing the right job as a leader in your companies.
That's great. Rob? Ditto. 20 seconds. Perfect. Go ahead, Jason.
Whatever your investment thesis is, just stay disciplined with it and don't just go chasing what everyone else the marketplace is doing. Following the money isn't going to be successful. Just stick with your discipline.
Gary?
Pick a program for participating in private markets that's comfortable to you. So I agree with the people that have just spoken. Know what you're doing and stick with it. The still reminder is that a lot of the value in our economy is built by private companies and not public companies.
Great. Samy, you get the last words.
Lucky me. So I agree with everything that's been said. Marco, you're fantastic. Thank you. Build the portfolio carefully, right size your investments. It's not just a matter of vintage. Don't go beyond your skis, and don't be just in the things you're comfortable in. So if you're real estate, don't be investing in real estate. You're just doubling up your exposure. Diversify, but make sure it's stuff you understand. If you don't understand what's in the OM, don't do it.
Great. Thank you, everyone.